Barbara is 71 years old. She lives in Ohio. Her son James is 43 and was laid off 8 months ago. He has 2 kids in school and a mortgage. He is struggling to keep current. Barbara has savings. She has a home worth $400,000 that she bought for $80,000 30 years ago. She has a brokerage account with stocks she has held for decades. She wants to help her son. It is her money. She earned it. She should be able to give it to her family. So she does what most parents would do. She writes James a check for $20,000. Then she transfers some of the appreciated stock into his name. Then, because she has heard you can give up to $19,000 a year without any tax issues, she gives another $19,000 the following year. 3 years later, Barbara falls. She is in the hospital. She needs long-term care. Her savings have depleted faster than expected. She applies for Medicaid to help cover the nursing home costs. The state looks back 5 years at every financial transaction she made, every check, every transfer, every gift. They find the $40,000 in cash in the stock. Transfer. They calculate a penalty. Period. Barbara is disqualified from Medicaid benefits for months, possibly longer. She is in a nursing home. She cannot pay out of pocket. The money she gave to James is gone. James cannot return it. The IRS told her everything was fine. The annual gift exclusion said $19,000 per recipient was allowed. She filed no gift tax return because she owed no gift tax. Medicaid operates under a completely separate set of rules that have nothing to do with the IRS, and nobody told Barbara. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional and a licensed elder law attorney before making any decisions about your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through the 3 specific rules the IRS and the government use that punish retirees for helping their children. I am going to explain why the $19,000 gift exclusion is one of the most misunderstood rules in retirement. I'm going to show you the capital gains trap that destroys wealth when parents give the wrong asset to their children. And I'm going to give you a clear action plan for how to help your family without triggering any of these consequences. Most of what I'm about to explain is not widely known. Your accountant may know the gift tax rules. Your financial advisor may know about capital gains, but very few people explain how these rules interact with each other and with Medicaid in a way that costs real families real money. Let me start with the rule that catches the most people by surprise. The IRS annual gift tax exclusion in 2026 is $19,000 per recipient. That means you can give up to $19,000 to any individual in a single calendar year without filing a gift tax return. A married couple can give $38,000 per recipient per year. You can give this to as many people as you want. You can give $19,000 to each of your 3 children, 7 grandchildren, and 2 neighbors, and owe nothing to the IRS and file nothing. If you exceed $19,000 to a single recipient in 1 year, you file Form 709 with your tax return, but you almost certainly owe no gift tax. The lifetime gift and estate tax exemption in 2026 is $15 million per individual. That number was made permanent under the One Big Beautiful Bill Act. You would have to give away $15 million over your entire lifetime before a single dollar of gift tax is actually owed. So the IRS rule is clear and relatively generous. Give under $19,000 per person per year. And you do not even have to report it. Give more. Report it on Form 709. Reduce your lifetime exemption. Never pay $1 of actual tax unless your cumulative lifetime gifts exceed $15 million. Here's where the trap begins. Medicaid is not the IRS. Medicaid is a joint federal and state program. It has its own rules, and its rules for gifts are completely different. When you apply for Medicaid long-term care benefits, the program that covers nursing home care, home health aid services, and similar extended care, the state looks back at your financial history for the 60 months immediately before your application date, 5 years. Every gift, every transfer, every asset sold below fair, market value during that 5-year window is reviewed. And this is the critical distinction that destroys families. That the IRS gift tax exclusion provides zero protection under Medicaid rules. None. Gift of $500 made last year can trigger a Medicaid penalty period just as surely as a gift of $50,000. The Medicaid system does not care whether you filed a gift tax return. It does not care whether you owed any gift tax. It looks only at whether money or assets left your control during the look-back window. The penalty for gifts within the Medicaid look-back period is calculated by dividing the total amount gifted by the average daily cost of nursing home care in your state. This daily cost is called the penalty divisor, and it varies by state. In a state where the average daily nursing home cost is $350, a gift of $35,000 creates a 100-day penalty period. In a state with a higher cost, the same gift creates a shorter penalty. So in a lower cost state, a longer penalty, but in every state, the math works the same way. The gift amount divided by the daily rate equals the number of days you are ineligible for Medicaid benefits. The penalty for gifts within the Medicaid look-back period is real, calculated precisely, and cannot be appealed simply because you did not know about it. The resulting number is the number of days you must wait before Medicaid will pay your bills. During that penalty period, you are expected to pay for care out of pocket. If you have already spent down your assets trying to qualify for Medicaid and you have no money left and the penalty period is still running, you are in a deeply serious situation, and the penalty period does not begin until the day you are otherwise eligible for Medicaid. That the clock does not start on the day you gave the gift. It starts the day you apply after spending down your assets. So the worst case is that you have given away money, spent down everything else, applied for Medicaid, and only then does the penalty period begin. This is not a theoretical risk. Long-term care is the largest unplanned expense in retirement, and it is one that most retirees do not plan for until it is already happening. According to the Department of Health and Human Services, about 70% of people turning 65 today will need some form of long-term care during their lifetime. More than 40% will spend time in a nursing home. The median annual cost of a private room in a nursing home in the United States crossed $100,000. Medicare pays for skilled nursing care after a hospital stay for up to 100 days under very specific conditions. After day 100, Medicare stops for most retirees who need extended care beyond what Medicare covers. Medicaid is the only program available, and Medicaid is the program that reviews every gift you gave in the last 5 years. This is not a theoretical risk. Long-term care is the largest unplanned expense in retirement. The median annual cost of a private room in a nursing home in the United States is over $100,000 per year. Medicare pays for skilled nursing care for up to 100 days under specific conditions. After that, it stops. For most retirees who need extended care, Medicaid is the only program that covers it. And Medicaid is the program that reviews every gift you gave in the last 5 years. Let me walk you through 3 people so you can see exactly how this plays out. Dorothy is 68. She gives her daughter $5,000 every Christmas. She has done this for 4 years. She never files a gift tax return because the amounts are under the annual exclusion. She assumes everything is fine with the IRS, so it must be fine with Medicaid. At 72, Dorothy has a stroke. She needs nursing home care. She applies for Medicaid. The state reviews 5 years of bank statements. They find $20,000 in Christmas gifts spread over 4 years. All of it is within the Medicaid look-back window. The state calculates a penalty period based on the total transferred. Dorothy is denied Medicaid coverage for a period of months because of gifts she gave to her own daughter from her own money within this annual IRS limit. Nobody told Dorothy the IRS limit and the Medicaid limit are 2 separate systems with no connection to each other. Robert is 70. He has a house worth $350,000. He bought it in 1990 for $60,000. His son, Michael, is going through a divorce and needs housing. Robert decides to deed the house to Michael to help him out. He is not selling it. He is giving it to his son. 2 years later, Robert has a health crisis. He applies for Medicaid. The house transfer within the 5-year look-back is flagged. The state values the transfer at $350,000. The fair market value at the time of transfer, the penalty period calculated from that amount, is severe. Robert is ineligible for Medicaid for an extended period. He has no house. He has limited savings. He is waiting for a penalty period to end while incurring nursing. Home costs he cannot cover. Robert also handed his son a tax problem he did not intend to create. Michael now owns a house with a cost basis of $60,000, the price Robert paid in 1990. When Michael eventually sells that house, he will owe capital gains tax on the difference between $60,000 and whatever the house sells for. If it sells for $350,000, Michael owes tax on $290,000 in capital gains. If Robert had simply kept the house and left it to Michael through his estate, Michael would have received a stepped-up basis equal to the fair market value at the date of Robert's death. Michael could have sold the house the next day and owed nothing in capital gains. Robert gave his son a $350,000 house and a significant capital gains tax bill. He intended to give him a gift. He created a liability. Linda is 73. She has a brokerage account containing stock she purchased years ago for $20,000. The stock is now worth $90,000. Her daughter is starting a small business and needs capital. Linda transfers the stock to her daughter to help. Linda's gift is within the annual exclusion for the year. No gift tax, no Form 709 required. But Linda's daughter now owns stock with a cost basis of $20,000. When the daughter sells it to fund the business, she owes capital gains tax on $70,000 of appreciation. At the 15% long-term capital gains rate, that is $10 to $500 in federal tax on what was supposed to be a tax-free gift from a parent. If Linda had simply sold the stock herself and given her daughter the cash, Linda might owe tax on the same gain. But Linda's income and bracket matter here. If Linda is in a lower income bracket and her long-term capital gains rate is 0%, which applies to single filers with taxable income up to $47,025 in 2026, she could have sold the stock herself, paid zero capital gains tax, and given her daughter $90,000 in cash, with no embedded tax liability. Same asset, same intention, entirely. Different tax outcome, depending on who sells. The long-term capital gains rates in 2026 are 0%, 15%, and 20% depending on income. For a single filer, the 0% rate applies to taxable income up to $47,025. For a married couple filing jointly, it applies to income up to $94,050. Many retirees in their early retirement, years before Social Security, and required minimum distributions begin are in this 0% bracket. They have a window where they can sell appreciated assets themselves, pay zero federal capital gains tax, and then give the proceeds to family as cash. This is one of the most powerful and underused strategies in retirement. It eliminates the embedded gain. It eliminates the carryover basis problem for the recipient. And if done, in years before the Medicaid look back window is a concern, it can be structured to minimize that risk as, well, the window is narrow. It requires knowing your income in the year of the SALI, but for retirees who have it available, it can be worth tens of thousands of dollars compared to simply transferring the appreciated asset directly. If this video is showing you traps your family has never discussed, hit the like button right now and share this with anyone you know who's thinking about giving money or property to their children. They need to see this before they act. Subscribe and turn on the bell so you never miss a video like this one. If what you just heard about Medicaid and the look-back window is something your family has never discussed, hit the like button right now. This is exactly the kind of information that needs to reach people before they make a decision they cannot undo. Subscribe and turn on the bell. I publish every week, and the next video covers another version of this trap. Now let me explain the stepped-up basis rule in full because it is one of the most valuable protections available to retirees, and it disappears completely the moment you give an appreciated asset away during your lifetime. When you die and leave an appreciated asset to your heirs through your estate, the cost basis of that asset resets to its fair market value on the date of your death. This is called the step-up in basis under IRC section 1014, confirmed and intact in 2026 under the One Big Beautiful Bill Act. Your Heirs inherit the asset at its current value, not what you paid for it decades ago. The practical effect is enormous. If you bought stock for $20,000 40 years ago and it is worth $300,000 today and you leave it to your child at death, your child's cost basis in that stock is $300,000. If your child sells it for $300,000 the week after you pass, they owe zero capital gains tax. The $280,000 in appreciation that built up during your lifetime simply disappears for tax purposes at the moment of inheritance. Now consider what happens if instead of leaving that stock to your child at death, you give it to them as a gift. Today, your child receives the stock with your original cost basis of $20,000. If they sell it for $300,000, they owe capital gains tax on $280,000. At a 15% federal rate on long-term gains, that is $42,000 in federal capital gains tax at 20% for higher. Earners, it is $56,000 plus state taxes in most states. You gave your child a gift worth $300,000. You also gave them a tax bill worth tens of thousands of dollars. They may not even realize it until they try to sell. The rule is simple, and it matters enormously for planning. Never gift a highly appreciated asset during your lifetime if you can leave it through your estate. Instead, the step up in basis at death eliminates the built-in gain entirely. No tax, zero. The gift during your lifetime preserves that entire gain and transfers it to your child as a future tax liability. There are situations where gifting makes sense. If the asset has not appreciated significantly, the basis issue is minimal. If you are making annual gifts of cash, there is no basis concern at all. If your estate is large enough that estate tax is a consideration at the $15 million threshold, gifting can reduce the taxable estate. But for most retirees with appreciated stock, appreciated property, or long-held investments, the step up in basis at death is worth more than any lifetime gift strategy. Here is your action checklist. 5 specific steps based on where you stand, right? Now, one more trap deserves its own moment because it affects retirees who are trying to help their children using their IRA accounts. When a retiree takes a distribution from a traditional IRA and then gives the cash to a child, 2 things happen. First, the full distribution is ordinary income to the retiree in the year it is withdrawn. If you pull $60,000 out of your IRA and give it to your child, you owe income tax on $60,000 at your rate. The child owes nothing on receiving the cash gift, but you paid the tax to fund it. Second, that $60,000 withdrawal may push your modified adjusted gross income over the RMA threshold for Medicare, triggering higher premiums 2 years later. It may make more of your Social Security taxable, and it is still a transfer that Medicaid will review if it occurred within the 5-year look-back window. Retirees who fund large gifts to children by taking IRA distributions are paying income tax on the transfer, potentially triggering Medicare search charges and still creating a Medicaid look-back issue. They think they are being responsible by using their own money. They do not realize that the funding source adds a tax layer on top of the gifting consequences. The better approach in many cases is to give cash from a taxable brokerage account or savings where the withdrawal itself does not create a new tax event, rather than funding gifts from distributions that are fully taxable as ordinary income.